Hey, Christina, can you title?
Well, good evening, ladies and gentlemen. Thanks for joining us. We're glad you're here tonight. My name's Robert Helms. I'm a partner at Collective Inner Circle, and we have a great evening lined up. This is a live stream, and we're streaming to lots of different places. So let's cover just a few logistics and housekeeping, and then we'll get right into the content. You guys have already submitted a bunch of questions. We're going to have an opportunity to have more questions. But since we are on different platforms at different times, if you respond on, say, George Gammon's YouTube channel, we may not all see that, and that's perfectly fine. On this broadcast, there will be a place for you to enter your chat, which will be awesome. And then if you miss any of our stream tonight, we will be recording this and making it available. So before we get into our content, just a couple of housekeeping items. So this is hosted by the Collective Inner Circle. Some of you are members. Some of you know about that. If you don't, the Collective Inner Circle is simply an amazing mastermind with 5 partners. You're going to meet the 5 partners here in a minute. And we have lots of great members. You'll meet some of our members tonight who have something to say on the topic. And then we've invited some special guests as well. So there's nothing to be sold tonight. There's no big upsell coming. It's none of that. We just wanted to get our smartest friends together and kind of debrief on what's happened and what we think might happen. So with that, I think we'll start by bringing up our Collective Inner Circle partners. The 5 partners include Kenny McElroy, who's everybody knows Ken, Mr. Real Estate, George Gammon, the Rebel Capitalist, Russell Gray, and Jason Hartman. So these are our partners. When we have a live meeting, the first thing we normally do, whether it's a day or 2 days or 3 days, is we get all the partners on stage and we share what's on your mind. So the context is this: we've just had a pretty amazing election in the United States of America. I want to find out what's on your mind before we bring up some of our guests. Let's start with Mr. George Gammon. Hey, George.
Robert, what's going on?
It's good to see you.
It's great to see you too. A lot to talk about.
Lot to talk about. I know leading up
to this election is we actually can talk. And we don't have to worry about being censored, right?
Well, you know, leading up to the election, you came out and said, I am a single issue voter. And maybe you want to share that.
Well, it's based on that discussion that we had with Mike. I think Mike's here as well, Mike Maloney. And Hartman, I think you were, maybe the 3 of us were talking about it. And we were discussing, I think it was education. And I was using the example of our good friend Josh that works for me, young Josh, and how he didn't learn anything in high school. And therefore, he wasn't brainwashed by this woke mind virus, as Elon Musk says. And now Josh is 21, 22 years old. He's making, he might be making 7 figures. I mean, he is doing phenomenally well. And it's because he really had an incredible education, not from what he learned in high school, but from what he learned online. And the conclusion there with that conversation that we had with Hartman and Mike Maloney was basically, it's like what the Bitcoiners say, that free speech fixes this. So no matter what problem we have in the world today, or what problems we'll have over the next 4 years, I'm sure we'll have plenty of them. The bottom line is, if we are still allowed to discuss it, the best ideas will prevail. And so that's why I was a 1-issue voter. After thinking about it, I'd probably add, avoiding World War III on there as well. That would be a big issue. But for me, it was all about free speech.
Excellent. Hey, Jason Hartman, what is on your mind after all that has transpired?
Yeah, to echo what George said, I'll do that in a moment. But first of all, I just want to say I am happy as a clam. And clams are happy. It's just a wonderful turnout. I mean, the right side of the aisle has complete control of the federal government as of January 20th, and that's just wonderful news. As far as free speech, back in 2016, I really was hoping that the first thing the Trump administration would have done is attack the big tech companies and their Section 230 exemptions, saying that they are platforms, not publishers. And it has been a really scary few years with the attack on free speech. It is the single biggest issue facing the human race. I was saying that during COVID, when most of us actually believed in COVID at the time. At least I did in the beginning. And so I'm just really happy with the result. And we've got a lot to talk about as it affects the real estate market, the economy. We've got an all-star cast tonight. I mean, Robert, look who's in the green room.
We got Kiyosaki, we got Schiff, we got Maloney. Yeah. It's going to be an incredible night, guys. That's for sure. Yeah. And Jason, I don't know if you heard this, but RFK said he's going to ban orange juice.
Orange juice is a scam. Nassim Taleb taught me that. Yeah.
I can't get a kick out of that one. That's an inside joke.
I always say, I'm such an impolite person to have a meal with. If you have breakfast with me and you have orange juice, I'll tell you orange juice is a scam.
That's right. That's right.
He'll tell you that on Voxer. All right, let's talk about real estate. Ken McElroy, what do you have to say? What's on your mind?
Oh, Jason, you cracked me up. Hey, first of all, I'm so pumped. Everybody knows that I got to interview RFK a couple months ago before the election, and we actually started engaging him when he was an independent. So I got to meet him and get to know him. I started to understand, kind of a deeper thing about big pharma and the healthcare. And of course, we all kind of knew about this, but he really goes at a deep level. So we were wildly excited when he switched over. And, Trump is a business guy. He's a real estate guy. We have 4 years with them. He put together those opportunity zones. He understands housing. He knows we're in a shortage. He knows it's got to be easier to build, and we have a supply problem, not a demand problem. And so, and of course, Kamala, I couldn't understand what she was saying, but
it depends which accent she was using, Kenny.
I know. All I've seen her on is a orange juice commercial. So I will tell you that the last collective we had in Las Vegas, we had George's friend, now our friend, Robert Barnes.
Yeah.
And Robert Barnes just kind of blows people away.
Did he call this or what, Kenny?
Oh, he called it completely, guys. Like he obviously closed room, collective, just our members. He basically outlined this whole thing, what just happened. Yeah. He's a month before the election, and everybody's like, "Oh, I wonder," but he laid it out almost perfectly. So he's been to several collectives. George is a good friend and his attorney. I could not be more happy with where we are, and of course having Musk around, to handle some of the other things with regard to cybersecurity and censorship and all that stuff. I could not be happier with where we are.
All right. Well, many of our questions that have come in have to do with real estate and interest rates. So save some of that. We'll get to Jason and Ken when it comes to that. But let's hear from Russell Gray. Russ, what are your big takeaways, epiphanies? How are you feeling?
Well, I'm going to keep it super short because I know we got Peter Schiff in the green room anxious to come out and talk. And we definitely want to hear what he has to say, probably a lot more than you want to hear what I have to say. But, I just think as a Main Street guy, what I saw was the entire country stand up and say, we want to change. And this mandate, based on both the popular vote, the Senate, the obviously the Electoral College, but I think it's probably looking like he's going to get a red House as well. and the Supreme Court, the way it's stacked right now, like it or not. And I think this is where we have to be careful. We can't inject what we want or what we like, because there's going to be differences of opinion. We just have to look at what we think is going to happen. But I think the one thing we need to prepare for is everything is going to happen fast. Trump moves fast. There's not many things to hinder him. That could be disastrous or wonderful, depending on your point of view. And so tonight, we want to just take a look at what is already we think is going to happen, how fast it's going to happen. And I think that as the landscape changes very quickly in investing, the economy, interest rates, lending, the financial system, the geopolitical system, our ability as investors and entrepreneurs to read and react is going to be very, very important. And that's why we get together and have these conversations. So the goal tonight is to pick up some insights, some ideas, and I think even to hear some things maybe you don't necessarily agree with, but set aside your personal proclivities and preferences. We're not here to say whether anything is good or bad. I mean, we have our opinions, but I think we're really here to say is what's likely and how can we best respond.
Yeah.
All right. Thank you.
If you're emceeing, definitely want to talk to Peter about tariffs.
Yes, for sure. And partners, feel free to jump in anytime as we're interviewing our various guests today. You know, George, you started talking about free speech, and I think it's such an important topic. And there is no one size fits all when it comes to it. It's kind of all or nothing. But if you're going to really believe in free speech, that means you have to completely support the person who doesn't think the way you do, the person that has an opinion different than you, the other side of the coin. And we're all about that. So
we have to support bad speech. You have to support dangerous ideas. You have to support bad ideas. And in fact, you know, and Peter is such a historian, he's going to know more about this than I do or I did. But I did some research for a video the other day. And, you know, freedom of speech is just integral into what makes America, America, even prior to the Constitution, prior to the American Revolution. If you look and study the colonies, I mean, it was all about freedom of speech. And what's so ironic is the problem they were having, not just with Britain, but with the colonies themselves. A lot of these Puritan colonies wanted to use censorship, and they wanted to ban people from their colony if they had, like, quote unquote, dangerous idea. And you just see, and you see all these people that were in favor of those types of ideas. And it's not just through the colonies. And then after the American Revolution, and then you look at the civil rights movement and MLK, and you look at freedom of speech through that lens, and you just see it over and over and over, where the people who are for freedom of speech or dissident ideas, allowing those ideas, even if they're dangerous, even if you disagree, are always on the right side of history. Always, always, always. And the people that are in favor of censorship are always on the wrong side of history. But the argument they use, whether it's a Puritan or whether it's a KKK member in the 1960s, or whether it's Kamala Harris or the Democratic Party today, it's always the same, that we need to censor to protect people from dangerous ideas. And it's just, you see it, it's like a cycle in history.
That is one way to protect people from dangerous ideas. The other way is to let those ideas into the marketplace and let better ideas trump those ideas.
That's
so
right, the marketplace of
great
ideas.
stuff. Well, excellent kickoff. We got lots of questions to get to, but before we do, let's say hello to our friend and podcast host and best-selling author, Mr. Peter Schiff. Hey, Peter, how are you?
I am okay. How are you guys?
We're good. It's good to see you. I know you have some definite opinions about what happened because I heard your latest podcast, but here we are just after the election. What are your thoughts?
Well, you know, I had been predicting Trump winning for quite some time now, and I thought he would win this election for the same reason he won the 2016 election, which was that the economy is in bad shape. It's much worse than the mainstream media and Wall Street, the Federal Reserve are claiming. And I knew that voters would, you know, want to change. They would be hoping that a new president can make things better. And so I knew they would go for Trump. I didn't think they would vote for 4 more years of misery because, you know, inflation has pushed up the cost of living dramatically. People are working 2 or 3 jobs now just to make ends meet. They're drowning in debt. And they're hoping that things get better. Now, I supported Trump I voted for Trump, though my vote didn't count, but I voted for him. But I didn't do it with any delusions that we would have a booming economy if he was elected. The unfortunate situation is things are going to get a lot worse during the Trump term. They would have got worse under Harris as well. I'm not saying that, but the main problem that the U.S. economy has is structurally there's a tremendous misallocation of resources and malinvestments. We don't save enough. We don't produce enough. We borrow too much. We spend too much. And as a result, we have a massive $36 trillion national debt. We have $2 trillion a year budget deficits, $1 trillion a year trade deficit. It's just a complete disaster. And the only way to fix it is to put the economy through an austerity. We have to stop spending, start saving, pay down debt. Interest rates have to rise. Asset prices have to fall. We have to go through a really protracted downturn in order to right the ship, and restructure the economy in a way that will work going forward with a real recovery. But Trump did not prepare the electorate for that. He did not run on an austerity campaign. Had he done it, he wouldn't have won. So he promised everybody free stuff, mainly in the form of tax cuts. No taxes on tips, no taxes on overtime, no taxes on Social Security, no taxes for policemen, no taxes for firefighters, no taxes for veterans. You name it, he wants to eliminate taxes. And we're going to have major tax cuts, which is the exact opposite of what we need. And all these tax cuts are targeted towards consumption. It's not going to stimulate investment. People are just going to spend that extra money on stuff. And so our trade deficits get bigger, and the budget deficits are going to go through the roof, which is what they did, during Trump's first term. And, during Trump's first term, he didn't fix anything. He didn't make America great. America got less great while he was president. The budget deficits got bigger. The trade deficits got bigger. The bubble got bigger. He didn't fix anything. But I guess in comparison to now, things were better 4 years ago than they are today, but they're going to be a lot worse 4 years from now because these trends are going to continue. And so inflation is, I think, going to really take off in a big way during the Trump term. Yes, people are going to get lower taxes and they're going to have more take-home pay, but they're not going to be able to buy more stuff. They're going to buy less stuff because I think prices will probably go up more than their after-tax incomes, especially if they're buying imports, which are going to be a lot more expensive due to the tariffs. And those are the tax hikes that Trump is promising, but they will not nearly offset the tax cuts. So it's still going to be a net loss of revenue. As far as the spending cuts, I really don't expect anything significant to come out of Congress. I mean, they never vote to cut spending. That's never happened. It didn't even happen under Ronald Reagan. They always talk about it, but they never deliver because nobody will vote for it. I don't care if you put Elon Musk in charge of another committee that we don't need, the Government Efficiency Committee, which is probably an oxymoron. The government will never be efficient by definition. But, there's really not much he can cut when almost everything is off the table. All the big ticket items, Social Security, Medicare, interest on the debt, national defense. There's very little left to cut and nothing's going to be cut. So I think we could have a blow up in the bond market with interest rates really rising as a result of soaring deficits. We could have a currency crisis. I mean, a lot of bad things could happen that unfortunately Trump might get blamed for. I mean, he's, if it happens on his watch, he's kind of the bag holder because we've been passing this baton from administration to administration. And instead of dealing with the problems, each president makes them worse and just gets out of Dodge in time. And then the next guy gets the hot potato. But it would be great if Trump, would do the right thing. I think the only chance he has, and this is a reason that I did vote for him, if everything does collapse early enough in his presidency, so hopefully it happens early, he may then do the right thing when there's no other option. I mean, when we're already in a complete economic, implosion, and then maybe he'll, when there's no choice, it's like, okay, we're already screwed, so maybe we could do the right thing. But I think initially, no, he wants to deliver on his tax cut promises, and he's hoping that, he can shoot the economy up with enough heroin that, we have another high, and maybe he thinks that, he'll be gone by the time the hangover hits.
Yeah, people remember that gas was less expensive and groceries were less expensive, but they probably don't remember that he didn't rein in spending. He didn't change the deficit except up. And so that is just one of the realities. And I think this problem didn't start in the last presidency or the one before that or the one before that, right? This is an ongoing issue that we have.
It's been going on. And a lot of the inflation that we've experienced at the supermarket and other places, was created under the Trump presidency. It didn't just start because they say, look, it's the big spending that causes inflation. Well, what about the big spending? Trump set the record for running up the debt the most in any one 4-year term. Biden just broke that, by the way. He's already outdone Trump, and his term isn't even over. But Trump, beat any of the Obama terms. So we created a tremendous amount of money during COVID. Trump was president. He signed all those COVID stimulus bills and the PPP and all these asinine programs. He was, bashing the Fed and demanding that rates go to zero and demanding quantitative easing when he was president. So he presided over tremendous inflation, and the consequences reared their head, while Biden was president. I mean, had Trump been reelected, we would have had the inflation under, Trump. So he just conveniently lost that election, and and now he's back, and he doesn't have to accept any of the blame for all the bad things that happened during that 4-year period. He's got like a clean slate.
Hey, Peter, take us through some of the market reaction, right? The stock market, crypto, gold and silver. We saw those markets all react. Take us through some of that and what you think that might mean.
Well, clearly, Trump is more business friendly than Harris would be. So a Republican who's promising lower taxes, lower corporate taxes, you would figure that's good for the stock market, particularly companies that believe that they're going to be the beneficiaries of Trump's policies. The banks had a huge run based on the fact that they think that Trump will deregulate banking more so that they can gamble more with taxpayer money, take bigger risks, and make bigger profits for themselves, and just leave bigger losses for the taxpayers when they need to get bailed out. Tesla had a big run, because now, Elon Musk might get some favorable treatment. The biggest move I saw was in the bulletin board stocks for Fannie and Freddie. A lot of Trump donors have invested heavily in those companies on the belief that Trump will pay them back by recapitalizing, releasing them from receivership, and enriching a lot of the funds that have invested. So a lot of Trump's donors, stocks where the donors were invested, who were expecting, to be compensated for their support. That's also what's happening with crypto. I think Donald Trump made a strategic decision, despite his, the fact that he never liked Bitcoin. He called it a fraud. He called it a scam when he was president. He recognized a political opportunity that there are a lot of people who are involved in crypto, and for them, there's only one issue, and that's crypto, because they're counting on that to get rich. So they're like a single issue voter. But the beauty of pandering to the crypto community is that you don't lose any votes in the process. It's not like, some people are one issue. I'm either pro-life or I'm pro-choice, right? That's all I care about. And if a politician takes a stand, he alienates half the voters. He gets some, but he loses some. But when you come out and you pander to the crypto crowd and you promise to use taxpayer money to buy Bitcoin and create a Bitcoin reserve and buy 1 million Bitcoin and drive the price of Bitcoin way up so that the people who own their Bitcoin can sell to the US government and make a bunch of money, right? When you promise that, the people who don't own Bitcoin don't even notice. They don't even care. You don't lose any votes. but they got a lot of votes. They got a lot of donations. Trump got a lot of donations from the crypto people who are hoping, right? Because, whenever you have a pyramid scheme, you constantly need like new buyers. And so crypto kind of ran out of buyers. And so they recruited Wall Street to set up a bunch of ETFs. And now that was the next round of buyers, the speculators who, have, bought ETFs. And then that kind of dried up and they couldn't get the price. So now they're trying to get the US government to come in and use taxpayer money to buy, or it's not even, they're going to have to print the money. They're going to get the Fed to print the money to buy the Bitcoin and hold it as a reserve. It's funny, they call it a strategic reserve. What's strategic about it? I mean, why do we need a reserve of Bitcoin? Like we're going to run out of Bitcoin? Like what do we need? It's not like oil where, we need a strategic petroleum reserve because we might need oil. We don't need Bitcoin. Nobody needs it. You just gamble on the price going up. But, Trump was like, I'm going to be the crypto president, and so when he won, more people bought crypto expecting the price to go higher. I don't think Trump is going to follow through with this. I mean, I think, he's going to break a lot of promises. That's what politicians do. I don't think he needs crypto people anymore. I don't think he needs their support, their money. He can't run for re-election. He never actually promised to create a crypto reserve. That was RFK who made that promise. Not all Trump said at that crypto convention in Nashville was that he won't sell any of the Bitcoin the U.S. government has. Well, my thought process is that Biden will sell all that Bitcoin before he gets to office. And so there may be a big sell-off coming. And that would actually be a very smart move for the U.S. government to make because he can sell that Bitcoin and pay off some of the debt. You can sell some worthless Bitcoin while there's still people who are willing to buy it. But, that's why that gold went down because the dollar went way up. And so people said, okay, Trump's going to grow the economy. And so we're going to have higher interest rates and maybe more inflation. And ironically, they think that's good for the dollar because they think that means higher interest rates. And, because the dollar went up and because interest rates went up, bond prices collapsed, gold went down. But I think they have that whole thing wrong. Trump is going to create inflation. That's not good for the dollar. And that's not good for gold. I mean, it's not bad for gold. It's good for gold. Inflation, is why people buy gold. Is why central banks. And I think Trump's policies, I know George Gammon mentioned tariffs, but I don't see tariffs as being positive for the dollar. I think, what tariffs do, first of all, it's you're being very hostile to the trading partners when you're saying that we're going to tax anybody who buys your products. But what the tariffs are going to do is it's going to make imports much more expensive for Americans. And therefore, Americans will buy fewer imports, right? Now, in most cases, there is no domestically produced alternative. So Americans just will buy nothing, right? They, whatever, they'll buy something, but they're not going to buy, something similar. I mean, they'll have to just do without a lot of products.
They'll have fewer goods and services.
Yeah, I mean, they buy more services or whatever. Yeah, because the goods are going to be more expensive. But now when foreign countries see that, we can't sell as much stuff to America because, these tariffs, so we got to sell our products to other countries or we're going to have to sell them domestically to, our own consumers. Now, the U.S. market is a lot less important and the U.S. dollar is a lot less important. I mean, why are we bothering to prop up the dollar so Americans can buy our products when the tariffs are preventing them from buying our products because they can't afford them? And so there's less reason to support the dollar. There's less reason for the international community to stock warehouse dollars. And so I think that it's just a negative for the dollar. And, I don't even know how much our trade deficit will go down as a result of the tariffs, because what we do buy will just, will be more expensive. And I don't know how they're going to work it because there's a lot of U.S. companies that import and then re-export. So are they going to get exemptions from the tariffs? Otherwise, the exports are going to be a lot less competitive if the imported components are so much more expensive. But then in general, I prefer tariffs as a way to raise revenue than the income tax. I mean, I think, and Trump even pointed this out, that before we had the income tax, the government ran, almost 40, 50% of the federal government's money came from tariffs, and nobody paid income taxes. And we should go back to that. And I would love to go back to that. But what Trump omitted was that back before 1913, the federal government total spending was less than 2% of GDP for the total government. Now it's 24, 25% of GDP, the federal government. And so it's impossible to run this enormous federal government on excise taxes like we did back then, on indirect taxes. The only reason we have a big government is because we have an income tax, and we couldn't afford this big government without the income tax. So if you want to get rid of the income tax, you got to get rid of the government that it supports. But Trump doesn't want to do that. He wants to preserve Social Security, preserve Medicare. These programs didn't exist when the country was running on tariffs. So, unfortunately, what we're going to get is we're going to have the income tax and the payroll tax. We're just going to have the tariffs on top. So we're going to have all these things, but it's still not going to produce enough revenue to cover all the spending. So the deficits are going to get bigger and bigger. When Trump came to office initially, the budget deficits, the national debt was 20 trillion when he was just under 20 trillion, and the budget deficits were about 600 billion a year. Now it's going to be over 37 trillion when he comes to office, maybe, or 37 trillion, it's 36 trillion now. And the deficits are over $2 trillion per year. And when he came to office in 2016, he started with interest rates at 0.5%. That's where they were. Now they're at 4 3/4. So the cost of servicing the mountain of debt that we have, that's much bigger, is a lot higher. So he's coming into a much weaker economy with a much bigger ticking fiscal time bomb. So, I don't think the policies of tax cuts are going to work. If you look at what happened in the UK a couple of years ago when Liz Truss, with a big deficit, tried to cut taxes, the British pound collapsed to less than 1-to-1 with the dollar. The gilt market tanked, and her career was over in like a month, right?
Yeah.
So it's possible that the bond markets will react to Trump the same way. Even though we got the reserve currency, we're not immune to the laws of economics.
What's interesting, Peter, too, is it's ironic that the better the tariffs work, the less tax revenue you generate, because the whole point of the tariffs is to decrease imports. And if that's your only source of revenue, then the better the tariffs work, the less revenue you get.
Yeah, and then what actually happens, George, is the domestic producers raise their prices because if to the extent that there is a domestic alternative. And so the government doesn't collect the revenue, a private business collects the revenue, but the consumer ends up paying a higher price.
And the quality goes down. I've actually lived in countries that have extreme tariffs, Ecuador and Colombia. And what ends up happening is the domestic business that is quote unquote protected, what they do, to Peter's point, is they raise prices usually because now they have a monopoly and they have no competition. But they get fat and lazy, and the quality of the product that they are creating just goes right in the toilet.
I mean, the best kind of tariff would just be an across the board, relatively low 5 or 10% tariff that's designed to raise revenue, right? Not, and if it protects the U.S., if it makes the U.S., businesses, all right, a little bit better. I mean, I think when America was a young country, they thought tariffs helped because it gave us a chance to build up our industry. But we're not going to build up the industry. I mean, we've destroyed our industry with taxes and regulations. So we don't have a nascent industry that's going to grow. So to the extent that we want things, we're just going to have to pay more for them, because Trump talks a lot about manufacturing. Manufacturing weakened under Trump. It weakened under Biden. It continues to weaken. But he talks about how we need to make things ourselves. And I agree, we need to make things ourselves. We don't have to make everything we consume, but we have to make stuff that we could trade. We can't just, run $1 trillion deficits. We just had last month was the worst merchandise trade deficit in history, with the exception of 1 month during the COVID, when the first month of when we freed up the economy and about 3 or 4 months of backlog came in. That was the only month that was worse than the month we just had. So the manufacturing, our economy has never been in worse shape as measured by the enormity of our trade deficit. But the only way we can make stuff ourselves, we have to rebuild factories, we have to rebuild supply chains, and we have to train a workforce. Now, where are the resources going to come from to do that? How long is it going to take to do that? And what's the economy going to look like during the transition? Because we have to move from a borrow and spend economy to a save and produce economy. So
and you need a regulatory environment that would incentivize that, Peter.
Yes, we also have to get rid of a lot of regulations, and maybe Trump will. Deregulating is easier than cutting spending because just get rid of regulations and get rid of some bureaucrats. But it's not going to happen overnight. And the reality is, we need much higher interest rates. That's what we need, but we can't have much higher interest rates with all this debt. So the debt needs to be defaulted on. The debt needs to go away, but nobody wants to acknowledge that, because if we keep interest rates artificially low, so we don't have to default on the debt, then we never get to the structural imbalances. Even though the Fed raised interest rates to 5.5%, they never actually got into restrictive territory. That was all a lie, because the borrowing and spending never slowed down. We had record borrowing when rates were going up. People didn't care. They just kept borrowing more money and going deeper into debt. Record credit card debt, record household debt, record government debt. We needed much higher interest rates. But the reason the Fed stopped hiking rates was because the economy was already buckling because we had so much debt. But you have to let it buckle. You have to let the bubble collapse. You have to let companies and governments default. That's the U.S. government needs to default. That doesn't mean that the bondholders should get zero. We need a restructuring. We need to reduce the debt to a manageable level that's actually payable from tax revenue, and that is not, confiscatory tax level. So people have to lose, but it's not like they're going to escape losses, because if they don't lose the default, they're going to lose to inflation, and their loss to inflation is going to be even worse. But
I want to point out about the tariffs, though, Peter, that I actually did a video on this. So I did some research this morning on the history, and the whole reason that we move toward an income tax as a society is because the tariffs created so much corruption.
More than the income tax?
Well, this was the thought process in the early 1900s, because what happened is those tariffs, when they were renewing them every year or every 2 years, it would create all this crony capitalism, because all of the corporations would try to vie to get their slice of the pie, so to speak, right? And this created this massive environment of corruption, to the point where the public knew about it, and they demanded a change. And unfortunately, that change was to get rid of the tariffs and replace them with an income tax. So my point is that if you're worried about central planning and government control, be careful what you wish for with those tariffs.
Yeah, I mean, and the irony of the trade-off too is, at least back then, everybody knew that the middle class paid the tariffs, right? There was no delusions about who paid them, right? And the trade-off was, hey, let's get rid of the tariffs that the middle class pays, and let's have an income tax that the super rich are going to pay. So the idea was to move the tax burden from the middle class and the poor to Rockefeller and Carnegie and Vanderbilt and all those guys. And so that's who was supposed to be subject to the income tax. But even then, the top rate was like 6%, but yeah, you had to really go up. I mean, it really like 1%. And I remember there was some talk, I don't remember, but I read that there was some talk about capping the rate at 6%. I think, and people said, or something, well, no, we don't want to cap it there because it might actually get that high or something. I don't know, but nobody thought they would pay the tax. And here now, the income tax, is 20, 30, 40%, right? It's way above anything we envisioned for Rockefeller, and the middle class is paying the tax, right? That's the trap that people fall into. The government says, allow us to have this new power. We're only going to use it against the really, really rich people, so you don't have to worry, right? And as soon as you fall for that, the camel's nose under the tent. It didn't even take long. They started jacking the interest rates up, the tax rates up right away with World War I.
Yeah.
But it wasn't until World War II. World War II was when they introduced withholding tax. But that's when they really and people forget that the payroll tax is just another income tax. It's like a 15% income tax that's only on wages. Although, so we have two income taxes. We pay the regular income tax, and then we pay the payroll tax,
Hey, before we let Peter go, one more thing I'd like to hear, because we've got a lot of questions that were submitted about this. You talked about the dollar, and the dollar, got stronger for 5 minutes here in the election. But I'd love to hear George and Peter weigh in on the long-term prognosis for the U.S. dollar. Some folks say it's a fiat currency, it's going to nothing. Some folks say you can't get rid of the dollar. Let's start with you, Peter. What do you think about the dollar moving forward?
Well, I think the dollar is going to fall. I mean, I think it has to fall substantially. It's been declining, over time, slowly. It's been in a downtrend against some of the major currencies in the world, like look at the Swiss franc, but you can really see the decline in the dollar's value when you measure it against gold. I mean, at the start of this century, you needed about $300 to buy an ounce of gold. Now you need $2,700. In 1970, you could buy an ounce of gold for $35. And before that, it was only $20. So the dollar's been losing value. But I think the dollar right now, its value is a function of its status in the world as a reserve currency. And people hold dollars and hold treasuries, and that enables Americans to import, $1 trillion a year plus more than they export, because the world wants those dollars, and we get their stuff. But it's a bad trade, because they get something of value, and we get something of value, and they basically get nothing. We just create dollars out of thin air. We don't have to expend any resources, any land, labor, capital. We just print them or create them. But the willingness to hold dollars, though, is a function of confidence and belief that those dollars are going to maintain their value in the future, and that the holders of those dollars will be able to use them to buy stuff that that we make, or at some point in the future. And I think as the debt is getting bigger and bigger and bigger, it's becoming more and more obvious to our creditors that we can't repay our debts with money that has anywhere near the purchasing power that it did when they loaned it to us. We've increasingly weaponized the dollar status and exploited it to our advantage, and used it to punish people that do things we don't like. So the world has political and economic reasons to move away from the dollar. And I think they're in the process of doing that. I think one of the main reasons that gold is 2,700 is because central banks around the world have been accumulating it, preparing their balance sheets for a post-dollar world. I mean, I think gold is going to be the primary reserve asset, which was the case before it became the dollar. And in fact, the only reason the world switched from gold to dollars in the first place was because the dollar was redeemable in gold. The dollar was as good as gold. In fact, It was better, because they got interest on their dollars, but they could get gold whenever they wanted, until we screwed them in 1971 and said, we're not giving you your gold. You're stuck with the dollars. So I think that we're close to the end of that, and I think it is going to fall precipitously against other currencies. I think all currencies are going to fall, in absolute terms. I mean, gold's going to go up in every currency. I just think it's going to go up more in dollars. And at some point, that's going to disrupt this whole, phony economy that we have, because the dollar is going to lose so much value that, we're not, it's not going to be the tariffs that stop us from importing. It's going to be the exchange rate. Everything is going to be so expensive. We're not going to be able to buy anything with the dollars. And the stuff that we got is going to be really cheap. And so a lot of the stuff that we have is going to be exported, because foreigners are going to be able to outbid us for a lot of stuff. And they may come in here and start buying up real estate and buying up companies. because everything will be on sale.
George, what are your thoughts?
Yeah. So in terms, I think what you have to ask yourself first is the dollar compared to what? Because if you look at the dollar compared to gold, I don't think I really have too much of a disagreement with Peter, especially over the long run. If you say the dollar compared to goods and services in the United States, I might have some disagreement with Peter over the next, call it 6 months, year, if we have a recession. But if you look at the 2020s, I probably see eye to eye with Peter. Where I differ is probably the dollar against other currencies, not so much because of the demand, but more so the mechanics of how the global monetary system is structured. And the way I see it is the demand for dollars globally actually controls the supply. So if you see the demand for dollars going down, as an example of central banks are dumping it or we're moving to a BRICS currency or whatever, the supply will also go down because the dollars outside the United States are basically credit. It's just credit denominated in dollars. So I always say the demand controls the supply. So since the dollar is unique in that way, it's a very, I think the probability is very low that the dollar, quote unquote, crashes against other currencies. Now, it's not to say it can't go down to 80, 70. I mean, in 2011, 2012, we got down to 70 on the DXY. But that was because, in my view, there was so much demand for dollars, and the dollar was actually going down because there was more dollars being created, and the velocity of dollars outside the United States was very, very high due to emerging markets growing and China. So I think the risk for the dollar relative to other currencies is actually to the upside. It's not really to the downside. That's kind of the black swan event. And again, I don't disagree with Peter as far as demand for dollars. I think that could, I'm probably agnostic as far as demand for dollars moving forward in the global economy. I don't know that I have a view. I can understand why central banks and governments would want to hold fewer dollars as far as FX reserves for obvious reasons, because there's counterparty risk. But as far as the private sector wanting to hold fewer dollars, I don't really agree with that. But so I guess the bottom line there is versus gold. I think I agree with Peter versus goods and services in the United States over the decade. I agree with Peter. Over the short run, probably disagree. But where I see things differently is because of the mechanics of the monetary system. I think that tail risk is to the upside with the dollar versus other currencies instead of to the downside.
Well, what's going to happen, George? So we're running, these $1 trillion a year trade deficits, which could easily be much larger if Trump cuts taxes and people spend that extra money on imports, which is basically all we've got. And so the trade deficit goes up, and now those dollars are exported. And what if our trading partners don't want to take those dollars and buy treasuries because the yields are too low and the dollar is falling, and they just want to get rid of them? And so,
why would the dollar be falling?
Well, we're exporting $1.5 trillion, right?
Right, but if so, what I would do there, Peter, is I would look at the trade deficit relative to the DXY, and I can't find any correlation. So to your point, let's say since 1980 or 1990,
they've been willing to recycle, right? They take the trade deficit and recycle it into treasuries or other dollar-denominated debt instruments. So they loan us back the money that they earn. But if they don't want to do that anymore, if all the foreign exporters that earn dollars just sell their dollars to get their local currencies, and there is no demand for
that would mean the supply would go down. So let's say that they dumped 10 trillion worth of dollars. The supply of dollars would go down by roughly 10 trillion.
Well,
so you have that equilibrium. Because
how does that happen? So I'm selling
credit, Peter, because it's lent into existence. And when the dollars are lent into existence, then what happens is when the demand goes down, there are fewer dollars being created. Therefore, on net balance, the credit goes down, and therefore credit is just the supply of dollars, so that's going to go down as well. It's a credit-based system. These aren't dollars that are printed into existence.
No, but existence. So where do we get the dollars to pay for all our imports? You don't think those aren't actual dollars?
Domestically?
No, we import something, or let's say I spend $1,000 to buy something from China.
Sure.
They send me a product. I send them $1,000. Don't they have the $1,000?
Yeah, but you have the offsetting liability on your balance sheet because
What?
those
What
dollars were
liability? I
linked
gave
to-
them dollars. They gave me.
No. Think about how were the dollars created, Peter?
What difference would it make how it was created? I have them.
Because
I use them.
it makes all the difference in the world, because what you're talking about is you're just looking at the asset side of the balance sheet as though cash dollars are just assets. But we have to remember that they were lent into existence. So when they were created, you created an asset, but you created an offsetting dollar-based liability.
Well, I mean, I don't know. What you're saying. It just doesn't make any sense. You're saying that it doesn't matter how big our trade deficit is. We can have the dollar's never going to go down, no matter how many dollars we flood into the world.
Well, let's take a look at Argentina, right? So why does Argentina, the peso, hyperinflate when they do similar things at the United States and the dollar doesn't?
Because the peso is not the reserve currency. Believe me. If we were a normal country, we already. I mean, it couldn't have gotten to this level if the world didn't just treat the dollar differently than it treats the Argentine peso.
Right. But it's the mechanics, though, Peter. Because when you look at a pie chart of the, let's say, currency units that exist in the world, the 99% of the dollars outside of the United States are credit. Therefore, they were lent into existence, which creates the dollar, but it also creates a dollar of debt, right? And plus interest. So if that dollar or that debt is paid back, then that dollar disappears. It's gone. Where if you look at a pie chart of the majority of the Argentinian pesos, they were not lent into existence, and therefore they're just an asset. So if demand goes down, all they do is pile up. And to your point,
the demand for dollars is not to buy U.S. products because of our deficit. The demand for dollars is to invest in dollar-denominated debt.
Well, Peter, look at a chart of the DXY since 2000, right? It goes straight down to 70, and let's say 2011. Why was that? Because demand for dollars went down, or because demand for dollars increased?
Well, I remember during that time period, we had slashed interest rates down to 1% after the .com.
Yeah, but we had them at 0% during the 2010s. The dollar went up.
But,
all right, guys. Well, we could probably continue down this vein.
The dollar did rally, but everybody else had these crazy monetary policies. But I don't see how the dollar's not going to get killed here.
Peter,
Rick Rule up here.
Grab dinner in New Orleans, and
yeah.
you.
I mean, how do you explain the dollar's almost at a record low against the Swiss franc? I mean,
so coming up, and it'll be the 50th annual New Orleans Investment Conference. Peter will be there. George will be there. We'll have this conversation over dinner, and
we are
Collective
going to be there.
Join us.
I found out I have to leave a day earlier than I planned. I was I was getting so many trips. We're in St. Bart's on the 24th for Thanksgiving.
All right. Well, big virtual hand to Peter Schiff. Appreciate you being here, my friend.
Rick Rule. How you doing, Rick?
Peter,
hey, look, it's our friend, Mr. Rick Rule.
He'll
Peter,
be in New Orleans.
I should introduce you to Hugh so you can meet up with him. You guys would enjoy having dinner. But anyway.
Well, let's say hello to our newest panelist and friend. Some of you know Rick Rule in the mining and speculation space, but you might not know that he's also got quite a background in banking. Before we're done, we'll tell you how you can find out more. We're talking about the election results and what we think it means. Rick, what are you thinking? What's your big takeaways?
Well, I got to say, I've enjoyed listening to you all visit with Peter for the last 45 minutes, and I want to concede that I'm neither an economist nor a political scientist. So,
thank goodness.
The broad-ranging narrative that you have heard is over. But what I am is a credit analyst, a green eye shade guy. And a lot of what Peter said from a narrative point of view, I agree with. Some of it I disagree with. The last conversation, as an example, reminds me of the great Doug Casey quote. The US dollar is the worst currency in the world with the sole exception of all of the others. And that's sort of where I go, but I'll leave that there. When Peter talks about the unsustainability of the debt, he's talking about it from a narrative viewpoint. Narrative isn't collateral, so I don't do narrative. I'm a lender. But let's look at the numbers. Peter rightly pointed out that the on-balance sheet liabilities of the U.S. government are now approaching $36 trillion. That's a big number, but people don't put it in context unless they're lenders. If I was going to buy a U.S. Treasury, I would look at the balance sheet and the income statement of my debtor, the U.S. government. The first part of the problem, Peter did a good job on, $36 trillion. But he actually, uncharacteristically, missed the bigger problem. Straight whiff. The bigger problem is the net present value of the off-balance sheet liabilities, not the nominal value, the net present value of unfunded long-term liabilities. Medicare, Medicaid, Social Security, federal pensions, military pensions, environmental trust fund, pick them all. That number, not according to some cranky old banker, Rick Rule, but rather according to the Congressional Budget Office, exceeds $100 trillion. I invite your listeners to write out $100 trillion on a piece of paper. There's actually 12 zeros after the 100, but before the decimal point. It is a big, big number. Let's examine from a creditor's viewpoint just how big that number is. First, you add the on-balance sheet liabilities, 36. Let's call it 30, net of the Fed's balance sheet, 30 net. And you add to that 100. That's 130. The Internal Revenue Service estimates that the aggregate net worth of private citizens in the United States is 140 trillion. So the borrower is attempting to get something in excess of a 90% loan to value. Remember that their only asset is their chattel, us. Yes, they have other assets. Let's suppose that they didn't pay me and I went to foreclose on Yellowstone or Yosemite. What do you reckon my chances are? I don't reckon they're real good. Let's look at the debt differently. Let's look at the debt as a percentage of GDP. $130 trillion in total liabilities, net present value of total liabilities, against a GDP of $32 trillion. And that GDP isn't available for debt service. The federal government already consumes 23% of it. You get where I'm going with this? And from a lender's point of view, if you can't do it on an asset basis, you have to do it on a cash flow basis, right? Like they got to be able to pay you back. Well, there's mathematical challenges there too. The on-balance sheet liabilities of the U.S. government are increasing conservatively by $2 trillion a year. But that other number that everybody conveniently ignores, the net present value of the off-balance sheet liabilities, are estimated, nobody has a firm grip on it, are estimated to be increasing by between $2 and $4 trillion a year. Let's use the skinny number, 2 trillion, and add the other skinny number, 2 trillion to that. The deficit is increasing by $4 trillion a year, which is basically almost 100% of federal gross revenues before they service debt or spend on anything else. So when you look at debt and you look at the ability to service that debt, Peter gave you the whole narrative. The arithmetic is ugly, really, truly ugly. How do we get out of it? Let's think about how we get out of it. I think I know the answer. I'm far and away the oldest guy in the panel, sadly. But I have a memory that goes back to the decade of the 70s when we had the same circumstance. We had too much debt. We had very high deficits. We had high structural spending. You won't recall, but we tried to win the war in Vietnam. We didn't. We tried to win the war on poverty. We didn't. All we got for that was a bunch of debt. And we couldn't, for political purposes, do what Peter suggested, the honest thing, which is default. What we did was very clever. We reduced the purchasing power of the US dollar so that we honored the nominal amount of the obligation, but we inflated the net present value of the obligation. And I think that's exactly what we're going to do this time. I think that some old geezer like Rick Rule is going to get paid whatever it is that Social Security pays me, and they're going to continue to pay me. So I'll get nominal satisfaction on the promise, but they're going to inflate away the purchasing power. I'll get $4,000 a month or whatever they purport to pay me, and that'll buy $500 or $600 worth of goods or services. If you dial back to the 1970s, according to federal government information, the US dollar lost 75% of its purchasing power. An ugly decade. We got through it. We'll get through this too. We will. It reminds me really of the description that Ring Magazine had of a George Foreman punch. They described it as severe but survivable.
Yeah.
I'm not looking forward to taking that punch, but I don't think at my age I can duck it, you know? So that's sort of how I feel in a very broad sense about the issue that Peter was discussing. I think his description of it from an economic point of view was good. I just thought you might want to hear of it from a lender's perspective. If I was looking at the U.S. government as a debtor and I was the creditor,
Rick,
I wouldn't want any money.
Rick, you own a bank, don't you?
Yeah.
Sorry?
You own a bank or trying to own a bank?
I'm a major shareholder, well, a reasonable sized shareholder in several banks, and I'm starting a brand new one.
Okay, well, good luck in the venture. First of all, I know that's an exciting thing. I want to give you a little bit of a spin on U.S. Treasuries and the U.S. debt.
Great.
So the way I look at it is I look at it as a spread, especially if you're an offshore bank. So right now, as an example, J.P. Morgan is paying 1 basis point on their deposits. I'm sure you would love that if in your bank if you could get it. And so the liability side of their balance sheet is basically free. I mean, people are throwing money at them and basically lending them money free of charge. And if
George, by the way, I want you to tell the listeners that one more time. If they are depositing their money with JP Morgan Chase, how much are they getting paid?
1 basis point.
Thank you. We'll return to that later in terms of our intention with regards to account interest rates. Thank you.
Yeah, and I looked at some of the banks in the Cayman Islands because I don't know if you've been listening to Groman, but he makes a great point that I think the third largest holder of treasuries is Luxembourg, and number 4, Cayman Islands.
Right.
So if he thinks it's hedge funds, I actually think it's banks because, as you know, if you look at the population of the Cayman Islands, I think they actually have more banks than they do people. And so I was looking at some of those, we'll call them Eurodollar banks, and the deposits or what they're paying on deposits, more than 1 basis point, but it's not even close to what you could get on just, let's say, a 3-month treasury or a 10-year treasury for that matter. Maybe let's just say 2%. So if I'm a bank in the Eurodollar system and I can basically borrow an unlimited amount of dollars, you know, that credit that I was talking about with Peter, don't you think those banks would have an incentive to buy those treasuries and pocket the spread because they don't want to take that FX risk if those deposits are denominated in dollars? So the
answer to that, George, is yes. Again, I was around in the 1970s, and I watched bankers do an extraordinarily stupid thing, which is to say that they bought long duration, fixed yield instruments with overnight floating rate deposits. And when the near-term interest rate went up, the U.S. savings and loan industry went upside down. The circumstance that you're talking about is a circumstance that exists right now. I personally, my bank, will never do time spreads. The idea that you lend long at fixed rates and you borrow short at floating rates has been responsible for the extermination of more financial institutions than greed and larceny has. I get exactly what you're saying. And believe me, I hope for their sake it continues. That's not the way I run banks.
But let's talk about that for a minute, Rick, because you have Battle Bank, your latest bank venture, and we're hoping to hear some news here soon about that. But given what's just happened, any difference you see as a guy who is a big shareholder of a bank in terms of the presidential choice?
No. I think that Trump probably will be good for business confidence in the near term. I think things like the tax breaks, the the proposed tax on the carried interest for hedge funds. I think that goes the way of the dodo. I think Wall Street will be very happy about that.
Yeah.
I think Trump will continue the democratic process of jawboning down the interest rate. I think he will, as Peter suggested, go through with massive tax cuts. I think the idea that he and Musk and Kennedy are going to make massive cuts to federal spending is silly fiction.
Yeah.
I remember the Reagan years. There's a wonderful book written by David Stockman, who you should have on, called The Triumph of Politics, that describes the fact that the Reagan consensus fell apart in 90 days after his election. So I think the whole circumstance that Peter described there is certain, absolutely certain. As I said, I would disagree with Peter about the strength of the U.S. dollar relative to other currencies. I think when I look at other countries' balance sheets, they're often better. But when I look at their income statement, which is to say how much economic surplus they generate relative to their debt, then it gets scary. Really, truly scary. I'd much rather lend to Robert Helms or George Gammon without having looked at your balance sheets or income statements.
Yeah. In other words, you'd rather lend to the United States than to Japan.
I wouldn't lend to either on a sovereign basis, on a bet. I think the other one thing I want to say that is a little different than what Peter said, I think he would agree with me. But the arithmetic around bond yields is, from my point of view, bad. Most bond buyers measure inflation by the CPI. And I think the CPI is a very odd construct. First of all, when it doesn't suit them, they don't include food or fuel. And any index that doesn't include lunch is something I have no use for, Secondly, they hedonistically adjust the values that they associate to price. But people don't buy hedonism. They buy apartments, they buy computers, they buy cars, all kinds of stuff. And the idea that the assumptions can be manipulated by the poll taker, I find strange. But the strangest thing of all is that the CPI doesn't include tax. Now, I guess the argument there is that it's neither good nor a service. But if you look at CPI differently, if you look at inflation the way I do, which is to say a measure of the deterioration of the purchasing power of my wages and my savings, the idea that the basket of goods and services that I consume is only escalating in price by 2.6 a year is silly.
Right.
Take yourself back 4 years. How much did it cost to fill your tank with gas? How much did groceries cost? Crisis become a political issue. Health insurance, rent, mortgages. The idea that the deterioration of the purchasing power of the US dollar is 2.6% is absurd.
And
Rick,
Rick,
and I believe that the basket of goods and services, sadly, I pay tax, means that the value of my savings in terms of purchasing power is declining at about 7.5% compounded. And that becomes really problematic if you're a buyer of the US 10-year Treasury. If you're getting paid 4.4 and you believe that your purchasing power is declining at 2.6, you're getting a positive yield. If you buy the 10-year at 4.4 and you believe that your purchasing power is declining at 7.5, that means the US government solemnly swears to you that they're going to make you 3% poorer every year for 10 years. The first promise, by the way, in my 71 years on Earth that they've made that I believe. But it sure doesn't make me a bond buyer.
Rick, would you have a different view if your expenses were denominated in yen?
Pardon?
Would you have a different view if your expenses were denominated in yen and the value of the dollar was going?
I wouldn't buy government bonds. I have from time to time in my life been a yen borrower. I mean, that carry trade was just too easy to do. And by the way, you didn't have to go against the yield curve to do it.
Right, but if your expenses were denominated in yen, buying treasuries, US dollar, and if the dollar is going up at a faster rate than your local inflation rate, then you're increasing your purchasing power. So do you think it's different if you don't have that US-centric view, or your expenses are denominated in dollars?
If you were a corporation and you could borrow yen on a 366-day basis, which corporations can, not overnight, but rather borrow it from financial institutions on a 366-day basis, and then buy a 1-year treasury. Well, I've done that trade. I was going to say I would do that trade. I've done that trade. What I wouldn't do is borrow overnight in Tokyo and buy a U.S. 10-year treasury.
But if you could match up maturities, so you
Yep.
borrow for 1 year, buy a 1 year.
In a flash.
Yeah.
Hey guys, can I jump in here? I want to try to bring this back to Main Street. Because I think what people are
back to the election.
yeah. So, well, but I mean the election, right? So policy matters. We have an administration coming in. He's got a Senate. He's got a fairly friendly Supreme Court. He's going to have, it looks like, a red house. So it may be a thin margin, but he'll have it. He's had 4 years. It's not like he's coming in green. He's 4 years of experience in the government before, and 4 years to get ready for his comeback. Bringing in guys like Musk, guys who know how to get stuff done fast. I think it's safe to say, whether you like his policies or don't like his policies, he's going to be moving very quickly. And so one of the things we've been talking about is the future of the dollar. We've been talking about the health of the bond market. We've been talking about inflation, which is kind of a byproduct of government spending. All of that trickles down into Main Street with interest rates, which affect real estate investors and every asset price that's out there. It's certainly going to affect the health of the financial system, because if they're raising interest rates and we got trillions of dollars in bonds out there purchased at the price they're at today, those balance sheets all fall apart. Rick, you're a credit analyst. I mean, what does this look like on Main Street in terms of availability of mortgages, the cost of mortgages, the health of the banking system? What does Main Street have to look forward to in the next 4 years?
Were you around in 1980?
I was.
Yeah. When you see the divergence that we've already seen in interest rates, where the Fed rate goes down and the yield on the long term goes up, which is to say when the market begins to assert control over interest rates, that's a really interesting time for policymakers. Whether that will continue in the Trump administration, I don't know. Let me rephrase that. I take Trump at his word to say that he believes in lower interest rates. And I think he'll deliver that. There is already in the private sector, although I wouldn't describe the private sector after aggregate public debt as solvent. It's liquid. And I suspect we're going to have a reasonably good market for the next 6 months. Perhaps we're going to have a great market for the next 6 months. And I hope people utilize that market to refresh their balance sheets in the same way that Buffett has done in the last 6 months.
Right. So
that's what you have to do. I mean, bringing it down to Main Street, bringing it down to people is something I really try to do. I try to ask people who have made plans for the next 10 or 15 years that are based on fixed income investments, based on the expectation that the spending power of their defined benefit plan pensions or Social Security is going to maintain their lifestyle. And it's not. It just plain is not. There is no way that we can honor these obligations arithmetically. It cannot be done. So what I think the political solution is going to be is to inflate away the net present value of the benefit while you pay the nominal benefit. So what Main Street needs to do is understand that the social construct in the United States is a fraud. And they need, some of them, to alter their lifestyle and alter their expectations with the expectation that they and their family and their neighbors and their friends are going to have to do more to help each other. Because the reliance on what used to be called the Commonwealth is just unsustainable arithmetically.
Rick, why do you think the debt matters for interest rates? So where I'm going with that is going back to 1980, you know what the national debt was, and going back to 1990, like right off the top of my head is about 2.9 trillion, something like that. We're up to 36 trillion today. And since that time, interest rates have gone down.
I suggest that we went through the 40 most benign years in economic history in 1982 to 2022. And I think that people's expectation was formed by 40 very benign years. I think that's over. I think too, George, and I hope I'm wrong, by the way. I really do. I hope I'm wrong. I think that in 1980, the aggregate public debt relative to GDP was much lower. In other words, we had more string for fraud. The on-balance sheet
GDP was 30%.
Yeah, debt to GDP was 30%. Now it's 110 or 115.
Yeah.
Which is to say two things. Our ability to finance the debt is less good. I'm not trying to say it isn't there. Compared to other countries, it's still good. Our ability to engage in quantitative easing, should there be a liquidity squeeze, to print more money without a real ugly response in the credit market, I think is gone. I think just very recently, the divergence that you've seen between the Fed funds rate and the long-term rate tells me that the bond vigilantes, having been asleep since the early part of the Clinton administration, have woken up.
I do want to point out that that's the exact same thing that happened in 2007, 2008. It's the same thing that happened going into 2000, 2001, is when the Fed cut by 50, the 10-year went up. It didn't go down. And then even when the Fed was dropping by, 150 basis points in January 2008, and taking it down to 3.5, I believe, Fed funds. From that point to June, July, the 10-year went straight up. It went to, I think it got to, I'm not sure exactly, but CPI actually went up to 5.6 in August. And that's when everyone was worried about inflation, August 2008. And they were talking about the Fed actually bumping rates and increasing rates. And then, of course, as you know, 2 months later, interest rates were at zero. So it's weird that we see kind of this cycle happen throughout interest rate cutting cycles where the 10-year just does the opposite of what you would expect.
I agree with you that American confidence to financial shenanigans has been amazing. I guess Americans are innumerate. I would point out to you that our room to maneuver as a consequence of both the on-balance sheet and the off-balance sheet liabilities of the government relative to GDP or relative to net private wealth are much, much, much worse today than they were then. I would also note, sadly, because of my age, that when the writing was on the wall for the circumstance that I'm talking about occurring in the 1970s, really the writing was on the wall in 1968. But nobody paid attention. Again, we had come off 20 pretty good years in the US after World War II, up to 1968. Really good years, actually. The Nifty 50, people had that same sort of confidence that they have now. It didn't take, in my memory, until 1972 for the cumulative pernicious impact of inflation to be felt by Americans. When gasoline that had been 25 cents was $1. When a McDonald's hamburger that had been 5 for $1 was $1.
And the Motel 6, Rick, don't forget about the Motel 6.
Well, this is the more
Used to be $6.
It's the Motel 69 now.
Rick always tells that story. It's great.
All right, guys.
Yep.
Rick, thank you. We brought a few more people on here. Feel free to stay on with us. We've got Mike Maloney, Dana Samuelson, and Scott Saunders, experts in their various fields.
And if you guys want more Rick Rule, New Orleans Investment Conference, I'll be there. George will be there. Robert Helms will be there. Rick Rule will be there. Peter Schiff will be there. Dana Samuelson will be there. So as you can tell, we could go on and on. We're getting some feedback, Jason.
Someone needs to turn down their volume.
Yeah, if you guys are listening, turn your volume down if you're not in
It's probably
headphones.
one of the three we just added. So
yeah,
you've got
okay. All right.
And Russell, by the way, if you try hard, you can have some fun in New Orleans too.
okay. It's
If
not
you try hard, you can have some fun. All right. Well, big thanks to Rick Roll. We'll see you in New Orleans. And let's add a Mike Maloney. I'm not sure that Rick is now the oldest guy. I'm not going to ask, but Mike Maloney, many of us learned a ton about gold and silver in the early days. He's also one of the first guys that I knew that drove a Tesla. Mike is a member of the collective inner circle, and you've seen a lot of elections, Mike. What's on your mind after Trump wins the election?
Well, it isn't, to me, it's not Trump, it's the dream team that he's bringing with him. That's what's going to make the difference this time around. He's got people that do get things done, and he's got a very, very interesting mix here with Robert Kennedy Jr., with, you know,
Elon, Vivek, yeah.
What was that?
Elon, Vivek, Tulsi. I mean, wow.
Yes, and even there was some announcements today. Do you know who Joel Salatin is?
Yep.
Regenerative farming and stuff. He's going to be
Yes.
advising the EPA, and so we have, or yeah. Anyway, I see exactly what Rick and what Peter see as far as there is a coming crisis, I think, and the numbers, as Rick points out, the numbers just don't work, and so, but in the second half of this administration, I see great hope if he can keep these people around him. Elon Musk, I was just looking at a chart of the cost of getting a kilogram into low Earth orbit, 1 kilogram. And when we were running the space shuttle, it was a little over $52,000. With the Falcon Heavy, it falls at around $1,500. Everything Elon Musk gets into, every time he's gotten into some business, all of the costs come way down. He is really into efficiency. And so if this is going to be his task as like the czar of government efficiency, I see this as a huge positive. RFK, with what I mean, the message that he sent to the FDA, if you've been on this wrong side, I've got 2 messages for you. Preserve your records and pack your bags. And he said that before the election. So I really do see the potential for a bright future out there. I do see a crisis in the short term. And I do see that we still, everybody is, at least one half of the country is feeling really good. And, the other half of the country, they have some things to rejoice in as well, as far as it's such a shame that RFK became such a threat to the Biden administration and became an enemy, to where they sort of, with the help of the media, made him look like a nut to the left, because he was like their perfect candidate. He is a 50s, 60s, 70s Democrat. Just right down the line. And, spending those couple of hours with Kenny, when you were interviewing him at Limitless, he's an amazing person. And he's so right in everything. I mean, I've got The Real Anthony Fauci, Bill Gates and Big Pharma, the book, and it's like this big and this thick. And it makes so many accusations to these people, and he didn't get sued. I mean, everything is backed up, everything is factual, yet he's portrayed as a nut for presenting all of these facts. And that portraying people as a nut was one of the ways of, it went right along with the censorship, trying to marginalize people and sort of brush them off to the side. So with these people involved, I think that yes, there's going to be some sort of financial crisis. It's going to happen soon. Some sort of banking or financial crisis. Although with the rates coming down, the banks that didn't do a great job of hedging their bond portfolios, their interest rate risks, with the rates coming back down, they're going to be less backwards in the future. Some of these banks, though, right now are just completely upside down. There's a lot of things that haven't been marked to market, but those things get better as the Fed keeps on pulling rates down. So I see a short-term crisis, but long-term, I don't think you could have a situation with a better outlook. And there's a couple of Democrats in this potential cabinet that he's putting together. So hopefully it sort of invites in the other side, because on the left, Elon Musk used to say, here's left and right. Maybe I should invert the left and right for the audience. And here was him. And then let me see, which side did I say was left? I'm going to go with my left.
Whatever, we get the idea.
Move,
Yeah.
yeah.
So he
Left
moved.
and right, and here was him, and the left just went like this. And I've seen this move towards extreme socialism and communism, and that is what I was really afraid of.
So
Yeah, that's
Mike,
a great point. I think a lot of times we witnessed that people voted against the celebrity side over the substance. Business owners and billionaires, you can use that as a negative, but those folks kind of know what they're doing. And I also think that P. Diddy meme that did a whole bunch of damage. Hey, we're going to get into real estate in just a minute, because most of the questions you guys submitted were about interest rates, inflation, and real estate, and some specific real estate questions. We got some smart real estate guys on. Before we do that, I want to introduce Dana Samuelson from American Gold Exchange. Dana's a member of the Collective Inner Circle, but also a physical gold and silver dealer. He always tells us that gold climbs the wall of worry. Dana, the gold market went down, which means people are feeling good. But tell us about what you think this election means for gold and silver, if anything.
Well, thanks for having me. It's great to be here with you all. The fundamentals that have been underpinning the gold market for the last couple of years are not going to change under the Trump administration. We've got the global South increasingly going to gold as a reserve asset. It's a tier one asset, of course. It's got no counterparty risk. Luke Groman has called it a treasury bond equivalent with zero yield and infinite duration. And it's slowly replacing the dollar as a settlement currency in the countries that don't want to continue to use the dollar. So I see central bank buying continuing to support gold. We're in a phase right now where markets are just knee jerking to the Trump election. But Trump is a disruptor. And we're in a very big cyclical change here where a lot of things are coming together at the same time. When was the Republican Party the party of the working man? I mean, never, right? Now it is, right? And he owns the Republican Party now. And vice versa. When was the Democratic Party the party of the elites? Never, right? So we've got that. You've got major media has been discredited by the fact that they tried to do a hatchet job on Robert F. Kennedy. And Kenny, thank you so much for the exposure that you gave us to Robert F. K at Limitless, because Mike was right. I mean, he's brilliant, and he's going to do some big things. My concern about Trump and the economy is that, and the administration, is that his ambition to disrupt and his ability to disrupt are two different aspects. What he'll want to do and what he'll be able to do may not be the same thing. But from a precious metal standpoint, I continue to see gold and silver moving higher simply because things are becoming more and more measured in gold instead of dollars. For example, oil. If you go back to the 80s, the gold to oil ratio all the way to 2008 averaged 8 to 10 to 1. Today, it's almost 40 to 1. And that goes against a whole host of other things. So I do think that gold is going to be one of the most desired assets as we go forward in an inflationary environment, as other tangible assets are going to be. But I think we're going to measure value more and more against gold instead of against currencies as time continues to pass, because of its acceptance globally by the global central banks and the record demand for it. Demand in 2022 doubled over the past 10 years for gold at over 1,000 tons. In 2023 was almost the same. 2024 is going to come out just a little bit less. So the appetite for gold is really strong.
Now, you're a physical metals dealer. We just saw the price dip. Did people buy the dip?
Yeah, we had a big day yesterday, which surprised me because the American buyer has been kind of on the sidelines between 2,200, 2,300, and 2,600. But I think they're starting to realize that, hey, this is a market that's just going to keep going. So we did have a pretty big day yesterday, and I was very pleasantly surprised by that. It means the American investors really starting to get into the game here finally.
So Dana, you know how I feel about gold. I feel like it's a barometer for what's going on. Rick talked about bond vigilantes, which basically means when inflation is going, people are going to require higher interest rates. So they're going to not bid as much for bonds. And to me, gold is a corollary to that, but it takes it a step further because people then are like, I don't even want to be denominated in currency. I just want to go straight to metal. We know that central banks have been loading up on gold. To me, that is the precursor of some fundamental shifts in the geopolitical or the financial system. Do you still feel like in this new administration, this new, like whatever the Trump world order is going to look like, that central banks are going to continue to feel like they're going to want to have gold on their balance sheet? Mike, this is a great question for you too. And if so, coming back to bonds, if money is going into gold rather than bonds, then what would that impact be on interest rates?
Well, the real thing here is the BRICS just finished their meeting, right? And there was no new currency that was brought about, and there won't be for quite a period of time if they ever come to that. But what they have done is they've rejected the SWIFT banking system, right? Because Russia's been denied that, and they're creating their own alternative to it, which they might not have done previously if we had not sanctioned Russia following the Ukraine invasion. They didn't have a reason to leave the international finance system as it existed before, and now they do. So that train has left the station.
Yeah, but they actually started that, this 12, 13 years ago. They've been working on this for a long, long time. This just poured gasoline on the fire, I think.
Yeah, and that's exactly right. And I don't think the Trump administration is going to change that. In fact, I think if he's very aggressive with his tariffs, it might enhance the train moving out of the station faster.
All right, I was going to ask Peter about gold, but we just didn't have the time. But Mike Maloney, you've been in the gold and silver world for a long time.
Do you think he would say anything different?
Robert, if you want me to.
One of the things that I'm saying, Dana says that he's seeing an uptick lately in the number of people that are interested in this. For us, the general public, the small investor, it's been crickets, but we've been seeing some big smart money taking positions. We've had, several 9-figure commitments lately. And so we are seeing these people with many hundreds of millions of dollars of capital available, getting ready for some. They feel, and smart money tends to be ahead of the crowd. The small investor, the average person, is sort of asleep, and it's amazing. Day after day after day, brand new all-time highs that never existed. And you're talking about, gold was like $2,000 just a little while ago. Now it's $2,700. And I was looking at a chart back in 2022, it's $1,700 to $2,700 in just a blink of an eye, basically. Yet it is crickets. It's amazing. I do think that it is, though, one of the ways that people do need. I like precious metals and I like cryptos. And there's a lot of things. I just think we've got this very weird, twisted economy, and we're going to see a very weird, twisted correction. It's hard to predict.
Hard to predict. It's easy to predict the past, but not the future. Hey, let's jump into real estate. Again, most of our questions had to do with that, and specifically to just take a couple of the questions and mold them together. Where do we see opportunities based on the new administration? Let's start with you, Ken McElroy. You've been in real estate a long, long time. You've been through presidential elections and changes in administration. What say you? Is there opportunity, and what do we have to be careful of in that Trump administration in real estate? We see opportunities.
Thanks, Robert. There's a couple things. One, when interest rates went up, call it a year and a half, 2 years ago, there was a big pullback for new supply of housing. So that's already happened, right? But like George likes to say, the pig through the python is the construction that's actually moving through right now. That's hitting the economy right now. So it started last year. It's going to go through this year, and it'll trickle over to the next year. But it's about 1 million units, roughly. But if you take a look at, and that's causing disruption, which is great. I mean, if you're a buyer of real estate, that's exactly what you want. So we plan on we're going to buy about 200 million in this fourth quarter of real estate. We already closed on half of it, and then we should buy somewhere in the 600-700 million next year, and we already have it all targeted. We're going to do 13 transactions through 2025, and we already have them mapped out. And the entire reason is because of disruption. And what that means is that rents are soft, occupancies are down, expenses are up, and loans are in default somewhat. Not in every case, but anything that was a bridge loan or say floater is in trouble. So from a acquisition standpoint, that's exactly the recipe. That's what I want. I want to buy that, fix it, and then wait it out until the supply drops off. And so, so I think it's a tremendous time if you have dry powder and you have your capital all set up and ready, programmatic capital for this year and next year, which is what we have. But I think if you look at probably the easiest thing for people to wrap their head around with this administration, the new one with Trump, is just to Google Trump's speech at the Economic Club in New York. Just go Google that. Now, it's possible that he doesn't follow through with what he said, but Trump is not a guy that he talks. He likes to talk and he likes to say what he's going to do. And we also have 4 years with him. So here's what he said. He said his goal is to get interest rates down to 3%. Now, we beat on the Fed before. That possibly could not happen, but that's what he said. He also said, which was very interesting, I haven't heard him say this before, anybody, we have a lot of federal land, and he's talking about potentially building on federal land. And that would open up, that would be huge. If he allowed that, well, of course, we don't know how it will be structured, but that would be huge. And then he's really targeting on regulation. What he's saying is zoning, regulations, and labor costs are about 30% of construction. And I have almost 400 million in new construction and development as well, because we're a developer and a general contractor. So all of that's happening. So if he can reduce that, reduce land costs, reduce the cost of regulation, what he said is the government, and then keep those in ultra low tax areas, which is also what he's saying, that's going to help everything. So, and I'll just give you one example of something that just happened for us. I own about 1,000 units in Katy, Texas, just outside of Houston. And I went for this called the HFA. It's a housing finance, or it's a Houston finance authority, and they're looking for affordable housing. Very smart to do this because renters need assistance because of all the inflation everybody's talking about. So they're actually going to eliminate our property taxes, which is like almost $500,000 a year. They're going to eliminate that on my project if I keep my project affordable. And the irony is that it's already well under the affordable cap. So I'm way under it. So for me, it's a no-brainer. But what it does for me is it increases the value immediately. It increases my cash flow immediately. And now I'm not running into scenarios where, my value is less than my loan and all that kind of stuff. So So I would expect a lot more things like that, with this administration, and Trump proved it before. Just look at the opportunity zones. Those were super effective. I actually have invested in some. We have some. We're building in some. That is up, I think, next year. And so I would imagine he might want to continue that, expand that. So, from a real estate standpoint, this administration it really understands what it's doing, because Trump also said in that speech, 7 million housing shortages, for affordable housing. We have an affordable housing problem. The thing that's going to fix it is supply, guys, period. When there's too much of something, the price gets regulated. And that's what we need. We need supply. It helps the consumer. It helps the homeowner. Of course, that kind of cranks the engine back up. So that's what I think is going to happen.
Hey, Kenny, let me ask you a quick question, because one of the things I've heard you say many times is the importance of population. And, we've had these borders where tons of people have been coming in. They've been occupying stuff. I just was reading today, first 100 days, massive, aggressive deportation. And Robert and I, Helms and I, had a experience here in Phoenix, and you were back here back then. And there was a very aggressive move towards kind of cleaning up undocumented people. And we owned some fourplexes that ended up like emptying out within a matter of weeks when this policy came out. How do you see if Trump really executes aggressively and there's really no checks on him with a red Congress? And he really aggressively works to deport people. How do you see that, if at all, affecting real estate or specific real estate markets?
Yeah, so it's interesting. I just actually did a bit of research on this. I was taking a look at where are people going, what cities, what counties, what states, where are they moving? And there's lots of ways to figure this out. Out-of-state driver's license, post office, one-way trips on Ryder trucks, one-way trips on U-Hauls, all that. You can look at all that data, and it's all over the internet. You can figure out where people are going. And if you take a look at, then I also looked at population growth, and in addition to migration, where are people going for the work from home and all those other things. That's a really important thing, Russ. Here's the interesting thing: as you start to look at where people moved away from, let's pick on Portland, let's pick on Chicago, let's pick on Seattle, which is where I'm from, let's pick on New York. You see a dramatic drop in rents. You see a dramatic drop in all kinds of stuff because people moved out of the area. New York is actually on the rent growth list. So New York had a really negative, so did California. California and New York had negative people, pouring out because of their policies and their government, yet they've had rent growth, which is unbelievable. And now if you point to places like, let's say Phoenix as an example, it's been the opposite. Because we even though, to your point, we have had some immigration here, but as we all know, they're all over the place. So there's a study that said if he really moves forward with the deportation, it'll affect 1.5 million construction jobs. 1.5 million. That's
like in the labor shortage? Is that what you're saying?
Yeah, and we don't really have a labor shortage, I wouldn't say, but it could be after that. And in addition to that, it's going to vacate buildings for sure. I mean, New York is kind of the poster child for that sanctuary city, and a lot of immigration went up there. But in all respect, if you look at the numbers, New York State should have gotten just a shot in the chin from all the stuff that went on. Yet the rents are stable and going up, yet housing's hard to get, yet, it doesn't make sense. But you could point to other cities that didn't have that immigration overload, and you can see the difference.
All right. So, hey, great stuff. I want to make sure we have time to hear Jason's perspective, because Jason, you're in single family in a bunch of markets, but I just think so many of the questions were specifically about real estate markets and is there opportunity, or should I keep my powder dry? I will just say I've known Ken McElroy for more than 2 decades. And there's been times when you and Ross are not buying. And the fact that this is a time that you're building and buying, we'll call that a clue and leave it at that. Jason Hartman, what are you seeing in terms of the real estate market? And what do you think the Trump administration is going to do for that?
Yeah, Robert, it's complex for sure, because as Kenny alluded to, if you do deportations and you have that issue, then you lose construction workers, but you also lose tenants, right? So, and someone has got to mute. There's a pretty bad echo. Let me see.
Yeah, mute your mics if you're not speaking would be great.
Yeah, it's Rick. He's got something going there. I just muted you, Rick. But when you're ready to talk, come on back on. So there's that aspect. But I think the big theme about Trump is going to be deregulation, and that is going to make it easier to build. It's going to make it easier to create supply. And, I posted on Facebook a few months ago, everybody's complaining about the housing shortage. How about we elect a real estate developer as president? That might help. Just a thought. And I remember I was giving a speech to a big audience in Austin, Texas, back in 2015. And I said, Trump is our first real estate president, And so I think it's going to be excellent for the market. I think it's going to be excellent for the country. I think we're going to see significant deregulation. I think people who are worried about property values, and remember, when Ken is speaking, you got to consider, of course, what asset class are we talking about? There's many asset classes in real estate. Ken's talking mostly from a large apartment perspective. I'm talking from a single family home perspective. I think people that are concerned about the market are going to see more stability in terms of value. I think there's going to be more optimism from investors. I think the opportunity zone thing is going to be revitalized. I've done a lot of shows on that over the years. And there's going to be definitely a focus on affordable housing. It's interesting to see the repartee that was going on today between not Trump directly, at least not that I know of, but some reporters talking to Jerome Powell saying, could Trump fire you? Could Trump fire other governors or demote them? And he said unequivocally no. And I don't think Trump can do that. But, it's interesting how Trump was sort of trolling Chairman Powell a few years back, saying, he's got to lower interest rates, keep the party going, yada, yada, yada. And so that's in there. But overall, I think this is just good for the overall economy. There's a lot of cross currents. It's complicated for sure, because of the immigration thing especially. But I really do want to hear the perspective of Scott Saunders, who's been very patient, and hear what he has to say, because he's just got so much knowledge. He specializes in 1031 tax-deferred exchanges, but he's really just an industry player. I've worked with his company for many, many years, and he's a collective inner circle member. Scott, talk to us. You haven't said a thing. In 1031 tax-deferred exchanges.
Are you there, Scott?
Yeah.
So, Scott, I think a big part of this, people want to know about tax, and we talked a little bit. It's probably good news for the 1031 industry. Lots of times we have.
Well, I've been quiet here because listen to a lot of good discussion. One of the things that's going to.
Go ahead, Scott. We can hear you.
Might be on a delay.
You're on a delay, so just ignore us and answer the questions.
You sound good, Scott.
A lot of good discussion. One of the things that's going
to. It's like talking.
You guys got a delay, killing me. So
just turn down your volume.
1031. You guys, here's what's going on. There've been a lot of questions on this with 1031 exchanges. We are safe. That's the good news right now. We're safe with 1031. The previous administration tried to cap 1031, tried to limit 1031. And what you're going to see with the Trump administration, Trump understands the value of 1031. To give you guys an idea on the scope of it, 1031s, there was a study done. They contribute $97 billion annually to the economy, create 976,000 jobs. So this is all the transactional activity. lenders, developers, investors, commercial to residential. So they're really a big component. What we're going to see, I think, on the tax side is I think we're going to see Trump coming out pretty strong, wanting to get some taxes done. If everything goes well with the House, we're going to have a Republican sweep. They're going to use something called budget reconciliation to push through tax reform fast. So you're going to see an extension of the Tax Cuts and Jobs Act. A lot of those tax rates extended. 1031s are not going to be touched at all. I think we're going to be in good shape. The other components that will come in, things like bonus depreciation. So right now, bonus depreciation has been phasing down. It's been sunsetting. That, I think, we stand a very high likelihood of going back to 100% bonus depreciation, which will be great for the economy. So that's going to be good for real estate. It's going to be good for business owners. It's going to stimulate transactional activity. Those of us in the real estate industry that use things like cost segregation, which is a great tax strategy, are going to benefit from that. So we're going to have all those things going on. It's going to be very, very favorable for real estate investors. Now, there is a little bit of negotiation. When you use budget reconciliation, there are some rules that they've got to operate under with setting a 10-year budget window. So some of those things might come into play, but I think we're going to really see a time where taxes are going to be lowered. We're going to be in a very business-friendly, investment-friendly environment. And that, to be honest, to Jason's point, which I think is accurate, I've noticed a little bit in the market, a little bit of hesitation with this election, not knowing which way things were going to go. And now that we've got clarity and we've got a very pro-business administration, would be good. And to give you a little background, the House Ways and Means Committee, they've been working for many, many months now with all these working groups, looking at different aspects of the tax code, how to make it more business friendly and more friendly for investment. So they've actually engaged in all these groups, been working on it very diligently. And now that we had Trump win and the Republicans sweep, they're going to be able to bring all of that information to the table. I think we're going to see the tax code helping investors, and that's going to stimulate investment and be wonderful for the economy over the next few years here.
Yeah,
All right.
I think that's an overriding theme of, in my opinion, the Trump administration is general overall rising prosperity. I think most people are going to benefit from Trump policies. Robert?
Yep. Good stuff. All right. We are in the closing round here. We have 10 minutes left, and let's just make this final Jeopardy. Closing thoughts. Anything we didn't talk about? Anything you want to bring up? We'll just go round robin. We'll start with George Gammon.
Closing thoughts. I think from a standpoint of what's really, really important for our society long term, I'm very optimistic. I'm probably less optimistic than the rest of the panel that Trump will deliver on his promises, because I think he's a blowhard. I think he's going to tell you anything that he needs to tell you just to get your vote. He's a politician, and he's a good politician, by the way. And I think he surrounded himself with the people that he thought could win him an election. I don't think he has any loyalty whatsoever to RFK. I don't think he has any loyalty to Tulsi Gabbard or any of the other people. And I think that I hope I'm wrong. I mean, I really, really, really hope I'm wrong. But I tend to agree with Peter here that I'm very, I think, cynical. And I would be willing to bet that at the end of these 4 years, we have more regulation, we have more government, and government spending as a percentage of GDP is probably higher. That's just me being honest.
All right. Well, that's what we came for. Rick Rule, what say you? Any closing comments? And let's come back quickly to that one basis point comment.
I think this will be a good decade for real pros, because I think it's a decade that clears the tourists out of a bunch of businesses. The 1990s were really good for me in the oil and gas business because all the tourists got kicked out. I think this will be a good decade for real estate guys who add value. There's been butchers, bakers, and candlestick makers that have had the wind of their back for 40 years with declining real interest rates. And they've, in a lot of markets, crowded the pros out. because the pros can't deploy capital as well. I think those tourists are going to get massacred. And I think tourists are going to get massacred throughout the economy. I think that's going to be very good for the best sort of 4 or 5% of Americans, people who can access credit, use it intelligently, and add value. In the real estate business, you know, if you can do what you guys do, which is take somebody else's mistake or take an over-leveraged property, improve the operations, run it like a business, as long as you don't get too, how do you say, addicted to cheap credit, which I think is going to go the way of the dodo, I think you're going to do great, because I think your market's going to be a lot less crowded. I know in financial services, these shakeups have always been good for me. You know, when things really blow up and the wise guys go to wise guy heaven, there's just more market left over for pros. And I think in every regard, if you want to see what you have to get through this decade, look for clues to the decade of the 70s.
Thank you for that. Dana Samuelson, what are your closing thoughts or ideas, or anything we didn't touch on you think we should bring up?
Well, just to flesh out a little bit, I think that Trump's ambition to disrupt things and his ability are going to be two different levels. His ambition will be much bigger than his ability. And I'm concerned that as he goes to make the changes he wants to make, he won't have the time it's going to take to get them done. So it could leave a door open for a lot of potential challenges in a lot of ways. I'm an optimist. I believe in the American way. I believe in our system. I'm hoping that he can harness it and make it more efficient. I do think that our debt's just going to continue to go higher and higher, and it's a big problem. So I think the people that are watching this should figure out ways to make sure that they're insulated from some of the challenges that are going to come. And I do love real estate. I think he'll be very good for real estate. So we'll see. Fingers crossed.
And probably not bad for gold and silver. Thanks, Dana. Hey, Mike Maloney, you've been around a while. You've seen the ups and downs. You taught us a long time ago to buy gold, and we're glad you did. What else do you want to bring up here in our final Jeopardy?
Well, I do agree with George in the blowhard statement, and that all politicians break promise. They make a bunch of promises, and then right after they get into office, they break them. And what we have seen before is that there will be some people that are supposed to be surrounding the new president, and then those people get sort of offloaded very quickly. I mean, Elon Musk was sort of an insider, in Trump's first term, and then became an outsider very quickly. However, if he can keep these people around him this time around, I do see at the end of this 4 years, I mean, Elon Musk is really all about making a law that all laws have a sunset period, that unless they're renewed, that they go away, because we've just got too many laws and too many regulations strapping us down. And if there's anybody that has to negotiate, I mean, there's nobody, I don't think, in history that has created more prosperity and introduced more change than him. And he is extremely efficient. And if he can do the job that Trump says is his job in the government, then we should see some amazing changes between RFK and people like Joel Salatin. I mean, I think it's great that the FDA and the EPA are going to be getting advice from people that have done things right instead of just done things for profit. So I just think that in the second half of this term that we may see some good things if George is wrong.
Robert, one thing I'd add to that I just thought of is, number one, being shot can change a lot of things in someone's life. It can really change their perspective. And then number two, I think we're going to know if Trump was just bullshitting pardon my French, on the very first day, because
Right.
if I'm not mistaken, he promised to pardon the kid that did Silk Road. I think his name is, I just Googled it here. It's Ross Ulbricht. The kid has been in jail for like 10 years. I mean, it's just absolutely, well, no pun intended, criminal what they did to this kid. And I believe Trump promised to pardon him or get him out of jail his very first day, along with, I think, some promises that he made to the J6 people. So we'll see if he comes through on those promises. If he did, then I think that increases the probability that I'm wrong. But if he doesn't, unfortunately, I think that increases the probability that I'm right.
He needs
There
to
is
pardon
something that
Edward
he-
Snowden too.
But I'm just
All
talking
right.
about the promise.
Yeah.
Excellent point. Hey, I want to bring up something in just a few seconds here, but Robert Kiyosaki is one of the members of the Collective Inner Circle. He had to bow out, and he knows Trump probably better than any of us. But Russ, you and I had a chance to sit with George Ross in his home for 2 hours. George Ross was Trump's personal and business attorney for 47 years. Probably nobody knows Trump better from a business perspective than George Ross. Anything you want to share about that meeting, Russ, that might lend some thoughts to who this man really is?
You know, it's funny because I was actually going to bring that up only because Donald Trump is the only person who's ever been in the White House that I've ever met or had any proximity to. And because he's a real estate guy, and we've been tracking real estate guys for a long, long time, stalking them actually, we ended up being able to be around a lot of people that were involved with him. So you and I, Robert, had a chance to meet a couple of the contestants in the original Celebrity Apprentice. We interviewed Kendra Todd, talked to the kid who took 4th place. I think his name was Chris something, and just having drinks with him, talking about what is this man really like. You had a chance to go visit Ivana in her home in Palm Beach, in West Palm Beach, and talk to her a little bit. I've had a chance to talk to Josh and Lisa Lannon. Josh goes hunting with Don Jr. and Eric. Obviously, we had those 2 interactions, long interactions with George Ross at his home. And on that drive from Manhattan back to Long Beach, I asked George point blank, I mean, it's just us in the car. I'm like, is this guy a lunatic? Is he an egotist? Is he out of control? Does he shoot from the hip? And the answer was an unequivocal no. The guy is very measured, very calculated, very disciplined. He comes off as being kind of shoot from the hip. He keeps people off balance, but he's always aware of what he's doing. And so I had that in the back of my mind as I watched his first administration. And the other thing that George said is that he's not a detail guy. Like, he just kind of, big picture, and then lets people take care of it. So he'd go cut a deal, and George would, clean up the not the mess, but clean up the details and get the deal done. And so when I tried to think about the way he approaches the job at hand and what he's really trying to do, when I got a chance to ask him at Freedom Fest in 2015 what a healthy housing administration looked like, or a healthy housing market looked like in a Trump administration, he gave me a one-word. He wanted to talk about immigration. He didn't want to talk about housing, but real estate guy, like, I want to talk about housing. And he just gave me one-word answer. He said jobs. And so then I looked at what he did, and I think this is what he really focused on. So what I see with Trump, and I think he will do this just like he did before, is he's going to drive down components of cost just the way you would expect a developer to do. He's going to attack interest rates. His thing is, hey, we got the best economy, the best balance sheet, or the best the best currency in the world. We should have the lowest interest rates. So he wants to bring down regulation, and he did that last time. I think he's going to be even more aggressive this time because he's not going to have as many impediments. He's not setting up for a second run. He's going to be unabashed at how aggressive he is. I think we're going to be shocked at how aggressive he is. I think he's already said he's going to attack energy costs. Energy is the economy. He's going to drive energy costs down. If you're an energy investor, maybe that's not great, but everything else in the economy will benefit from that. And I think the tariffs are going to be about bringing manufacturing back. I just read an article today that Steve Madden Company is already talking about moving their manufacturing out of China because of the tariffs. And we saw a lot of that beginning to happen last time. I think we're going to see more of that. So I think that he's going to aggressively be more of what he was in Trump 1.0, in Trump 2.0. My concerns are if he loses control of velocity. I think his game, if I had to guess, is going to be to use a lot of debt because he's a real estate guy. He's not afraid of debt, drive down all the unessential components of cost and work at bringing up employment and bringing up wages, which could be very inflationary. At the same time, he's picking up velocity. So production is going to be the key. If we can bring production way up at the same time we increase velocity. I learned from Alan Green's article Alan Greenspan wrote back in the late 90s that productivity gains can mute inflation. And I think that's the game he's going to try to play. And so I'm going to be looking for signs that happens. And then how he uses the tax code, as Scott was talking about, to begin to direct where that money goes and where the opportunity goes. And to Kenny's point and Jason's point, I think a lot of it is going to be directed towards real estate, because one of the big problems we have in the country in terms of the domestic economy is real estate housing and real estate inflation. And the answer to that's going to be supply. So all in all, I think it's going to be very positive for Main Street. The danger is if he loses control of inflation. And that's a very real danger in my mind. So we're just going to have to watch and see how it plays out.
Jason Hartman, final thoughts.
Yeah, gosh, there's just so much to it, but I thought Russ made some very good points, and I think we are in for just a great time, a great ride. I think Trump is going to be dramatically more effective than he was the first time around, in a good way. I do think he's going to avenge some of his enemies, but they probably deserve it. So I'm okay with a little bit of that. I think he's going to be great for the economy. I do think, to the points George made earlier and even Peter was making, I think, we're going to end his term with more regulations, a bigger deficit. But that's the track that's just the nature of the beast. Like, that's going to happen anyway. So the comparison is not the comparison to where we are now in terms of how many regulations, how many ridiculous laws do we have, and how bad is our debt and our deficit, right? The comparison is to what would it have been if the left wing took over, God forbid. Thankfully that didn't happen. I mean, look, it's always a compromise. We don't get the government we want. We get the government we deserve, as the saying goes, right? So, but overall, I think it's extremely positive, and we definitely got the best deal we could have gotten. To Mike's point, the dream team. I think that's all very real and very positive.
All right, and we'll give the final word to Mr. Ken McElroy. What are your thoughts, my friend?
Oh, thank you. I'll be brief. I think everybody should just stay at 30,000 feet and look what's happening. And so there's a few things happening. One is there's an office building commercial market crash. That's an opportunity. The 5 to 6% interest rates that we have right now are normal. 3%, just like we saw, can create another bubble potentially. We have a little window, but you just gotta, these things can change from year to year. And then I think one big thing that we should all keep an eye on that is going to be a huge real estate opportunity is going to be nuclear power plants. And if you take a look and just Google how many nuclear power plants are being built across the world, there's I think 1 or 0 in the U.S. Right. And there's like 300 being built around the country. And the only reason I bring this up
around the world, you mean? Yeah,
throughout the world. Sorry, we need them for AI, not for anything else. We need them for AI. And so, when you start to see this, I think the next one that is in Wyoming, that's going to create these little pockets of infrastructure and population and jobs and stuff. And I'm telling you, this is kind of what's going to happen is Trump's going to, he obviously the Green New Deal is not a good deal. So he's going to be looking at these, I believe, nuclear power, and that's going to create housing. It's going to create all kinds of stuff. And I think you're going to start to see that in the next 4 years.
All right. Well, big thanks to the Collective Inner Circle partners. You see on the screen now all of the members and guests who came on today. If you're interested in being around a group of folks that has these conversations and thinks and has dinner together and does fun stuff, then you can learn more about the Collective Inner Circle. And in just a minute, I'll ask Russ Gray exactly how folks should do that. And then the other thing we mentioned is many of us will be November 20th to the 23rd in New Orleans for the New Orleans Investment Conference. It's the 50th annual conference. It's a resource conference. We're talking about real assets, gold, silver, oil, gas, real estate. You'll hear from George Gammon. You'll hear from Russell Gray. You'll hear from Dana Samuelson. You'll have the opportunity to be master of ceremony by yours truly. And that's going to be a great opportunity to be there. Big thanks to Brian London for not only hosting that, but for promoting tonight's town hall. And let us know what you think. Should we do more of these? It's great to get folks weighing in. Russ, if someone has interest in finding out more about the Collective Inner Circle Mastermind, what's the best way for them to do that?
Yeah, I'm just going to keep it super simple for everybody. If you're interested in the next town hall and telling us what you think about this one, or if you would like to get information about how to join us, not only for the New Orleans Investment Conference, those of us that are going to be there, Robert's be there, George will be there, I'll be there, Rick Rule will be there, Dana Samuelson, there's going to be a bunch of us there.
You should come.
And the real estate guys always do a party. So if you want to come to that, and it's a VIP party, so you get a chance to hang out with a bunch of cool people. Or if you want information about the Collective Inner Circle Mastermind, just send an email to membership@collectiveic.com. And it's going to be personal. Actual human being is going to read it and respond to you. Just give us your feedback, ask your questions. We'll get you information, whatever you need. Just membership@collectiveic.com. Really appreciate everybody being here and being patient with us as we plowed through all of these viewpoints. A lot of information to process. We got lots of questions we didn't get to, but if you guys like this, we'll continue to do it because we do want to answer your questions. This is going to be a lot going on, right? We're not going to solve it all in 2 hours. But that's why we get together and talk. There's a lot to process. Things are going to be moving very quickly. Going to be a lot of challenges. There's going to be a lot of opportunities. When we rub our brains together, we typically can navigate all that better. So appreciate y'all being here very much.
Many of you found out about this because you subscribe or listen to one or more of our channels. We appreciate that. Here's a great way to get exposed to some new ideas. Big thanks to all the folks who spent a couple of hours with us, whether you're watching the replay or live. And we'll see you next time. Here's to a fabulous rest of the year and hopefully a very, very bright 2025. Thank you, everybody.
Thanks, guys.
Happy investing.